Hello everyone, my name is Dr. Anshul Sharma. I take the lecture of financial management for you. As I have discussed in earlier slide about the capital budgeting. So today's lecture will be continue on the topic of, financial management. The name of the topic is the capital budgeting. In last slide, I have discussed about the theory of capital budgeting. I have discussed about the capital budgeting techniques. I have solved number of numericals for you, and I think today is the last lecture on this topic. So I will cover remaining topic, and as well as I will review all the topics which I have covered in this chapter earlier. So let's start with numerical. So this was the last question which we solved in last lecture. For today's lecture, this will be the numerical for you. If we read the numerical problem, then we find that it is given in the question, this is a Pioneer Steel Limited is considering to purchase a machine require an initial cash outlay of rupees 10,000 and have a life of 5 years. The company's required rate of return is 10%. Company pays tax at a 50% rate. The cash flow after tax expected to be generated by the project are as follows. So years are given to you 1, 2, 3, 4, 5 and cash flow of the project 4,000, 4,000, 4,000, 4,000, 4,000. So you have to find out payback period, discounting payback period, net present value, profitability index and internal rate of return. So all things you have to calculate. Let's summarize the problem again. In this problem, it is given to you that there is a Pioneering Steel Limited and the company want to purchase a machinery. And whenever the company has to purchase a machinery, it has to pay rupees 50,000 as rupees 10,000 as a cash outlay. It means the cost of machinery is rupees 10,000. And in exchange of it, company will use machinery up to 5 years. And in these 5 years, company will generate cash flow after tax of 4,000 every year. It means company will generate cash flow after tax of rupees 20,000 in 5 years. Now, you have to calculate payback, discounting payback, NPV, profitability and internal rate of return. I have discussed around all the techniques, but one technique is new. This is the discounting payback technique. We have solved the problem of payback period, net present value, profitability index, internal rate of return. We have discussed, we have solved, but this is a new thing for you. So first of all, start with the payback period. First of all, 0, 1, 2, 3, 4 and 5. These are the different years. Now write down cash flow after tax. In initial year, because you are spending rupees 10,000 to purchase a machinery, so this is the cash outflow. So right here rupees 10,000. This is a negative figure. because this is cash inflows and here I am writing cash outflow. So in column of cash inflow, whenever I have to write the figure of cash outflow, I have to write down it with negative sign. Now, it was given in the question that machine is generating cash flow after tax of rupees 4,000 every year. So this is 4,000, 4,000, 4,000, 4,000 and 4,000. These are the cash flow after tax. Now write down present value factor. Present value factor at 10%, as we have discussed number of times that present value factor of 10% in 0 year will be 1. So I have discussed earlier that whenever we have to check present value factor at any rate, it may be on 10%, it may be on 12%, it may be on 14, it may be on 16, it may be on 20%, or it may be on any rate. Whenever we have to find out present value factor at any rate, it will be 1 in 0 year. It's a fact. Now, I have to find out present value factor for first year. Number of times I have discussed that whenever you have to write down the value of present value factor, you may take the help of, as well as you have the option to calculate present value factor. What is the way? Simply you have to do 100 by 110. If you have to find out at 10%, you have to write 100 by 110. If you have to find out at the rate of 12%, then present value factor will be 100 by 112. If rate of discount is given to you 20%, then it will be 100 by 120. So I think it's very much clear to all of you. It means in numerator you have to write down 100 and in denominator you have to add rate in with 100, and it means you have to add 100 plus rate of discounting. If rate of discounting is given 20%, it will be 120. If rate of given discounting is given 10, it will be 110. Now 100 divided by 110, it will be 0.909. In second year, it will be 0.826. It will be 0.751. 0.621. Clear? So these are the present value factors. Now you have to find out present value. Whenever we have to calculate present value, simply we have to multiply both the columns, column number 2 and column number 3. So here it will be 1 lakh. Now to calculate, I am taking the help of calculator. This is 0.909 into 4,000. It will be 3636. If we multiply 0.826 by 4000, it will be 3304. If we multiply 0.751 by 4000, it will be 3004. 0.683 into 4000 is equal to 2732. 0.621 into 4000, it will be 2484. Basic calculation we have done. Now let's start to find out the things which is required in the question. So first thing which we require in the question is payback period. Whenever we have to calculate payback period, simply we have to write here cumulative CFAT. Cumulative CFAT. These are the CFAT, so simply you have to add it. 4000, 4000, 4000 plus 4000 is equal to 8000 plus 4000 is equal to 12,000 plus 4000 is equal to 16,000 plus 4000 is equal to 20,000. Now you have to calculate payback period. Write down the formula. Payback period is equal to 1 to 2 year we covered rupees 8,000 and in third year we will recover rupees 12,000. It means after 2 years and before completion of third year we will recover the total amount of rupees 10,000. And what will be the exact point? To find out we have to use this formula. 1 to preceding year, 2 years plus preceding year, 2 years plus 12,000 minus 8,000, 10,000 minus 8,000 divided by 12,000 minus 8,000. Now 2 years plus 10,000 minus 8,000 will be 2,000 and 12,000 minus 8,000 will be 4,000. It means 2,000 divided by 4,000. It means 2 plus 0.5 years. It will be 2.5 years. So this is the answer. Now if you have to calculate discounted payback period, I have calculated. Now I have to calculate discounted payback period. To calculate discounted payback period, we have to follow same approach. But for calculation of payback period, we are adding cash flows. But whenever we have to calculate discounted payback period, we have to add present values. So write down cumulative present value. Now first of all 3636. Add 3304. It will be 6940. Add, I am taking the help of calculator. 3636 plus 3304, 3304, 6940 plus 3004, 9944 plus 2732, 2732, 12676, 12676, 2484, 160. Use the formula of discounted payback period. In same way, we will calculate discounted payback period. Number 1, 2, 3. If we find, what you have to do, simply you have to check the point where we will recover rupees 10,000. If we see the column, it's very much clear that 9944 we are recovering in year number 3. But in completion of year number 4, we will recover 12676, and we have to check the point where we are getting rupees 10,000 in return. So what you have to do, simply use same formula, 1, 2, 3. Here number of years are 3. It means the preceding year of the year in which we recover the whole amount. The year in which we recover the whole amount is 4, so the preceding year will be 3. 3 plus 10,000 minus 9944, divide by 12676 minus 9944. Let's take the help of calculator. If we deduct 9944 from 10,000, it will be, and if we deduct 12676 minus 9944, it will be 2732. 2732. Here we will write 56. Now 56 divided by 2732 will be 0.02. So 3 plus 0.02, it means 3.02 years. This is the discounting payback period. Now, after calculating discounted payback, you have to calculate profitability index and net present value. To calculate net present value, first of all, let's start. To find out NPV of any project, simply you have to write down sum of present value of cash inflows. Write down sum of present value of cash inflows. sum of present value of cash inflows. If we add 3636 plus 3304 plus 3004 plus 2732 plus 2484, if we take the help of calculator, it will be 15160. So I am writing here 15160 because I have done it earlier for calculating discounting payback period. This is the cumulative value, and cumulative value means 366 plus 3304 plus 3004 plus 2732 plus 2484. If we sum up all this value, the resultant figure was 15160. So this is the summation. So write down here 15160. This is sum of present value of cash inflow. Now write here cash outflow, present value of cash outflow. Present value of cash outflow, you have to deduct present value of cash outflow from cash inflow. Cash outflow means initial investment which you have done at the initial stage. It was rupees 10,000. So deduct rupees 10,000. NPV will be 5160. This is NPV. So we have sold three things: payback period, discounted payback period, and NPV. Now, number 4, you have to calculate profitability index. The formula of profitability index is PI is equal to present value of cash outflow, present value of cash inflow divide by present value of cash outflow. Into 100. Now cash inflow is 15160 divided by 10,000. It will be 151.60. So profitability index is 151.60. Now we have done 4 calculations for the numerical. Now we have to calculate internal rate of return. This is the final thing which we have to calculate. Now to calculate internal rate of return, first of all, let's clear the board so that we may use the space for the calculation of internal rate of return. For calculation of internal rate of return, I have discussed that we need 2 NPVs. First NPV I have calculated, this is 5160. Now again I need an NPV. Again I need an NPV. What is the meaning? It means I need 2 NPV. One should be in positive and another should be in negative. So to calculate another NPV, what I have to do? Simply, whenever I have to calculate internal rate of return, this is a trial and error method. So what should I do? Simply, I have to apply different rate. and I have to find out actually the rate where NPV will be 0. So I have to apply different rate and one rate, or you can say by the help of the interpolation I will find the exact rate of return. Now I have calculated it at 10%. Now let's try on 20%. So whenever I had to calculate NPV, simply what I have to do, I have to write down present value factor, and after that I have to multiply with cash flow after tax. Then I will find present value. Last time I have applied present value factor at the rate of 10%. Now I am applying at the rate of 20%. Present value factor, I am taking the help of calculator to find out present value factor. What I am doing? Simply I am doing 100 by 120. This is 0.833. For 0 year, it is always 1. Into 100 by 120. This is 0.694. Into 100 by 120. 0.578. Into 100 by 120, 0.482, 100 by 120, 0.401. So first of all, whenever you have to calculate NPV, simply we have to write down the present value factor. So I have write present value factor at the rate of 20% here. Now second thing, I have to multiply this present value factor with cash flow after tax. Column number 2 and column number 7. I have to multiply column number 2 and column number 7. Now 0.833 into 4000. Write down here present value at 0.833 into 4000. 3332. Now 0.694 into 4000. 2776. Now 0.578 into 4000. 2312. 0.482 into 4000. 1928. 0.401. 1604. 1604 plus 1928 plus 2312 plus 2776 plus 3332. 11952. 11952 less 10,000. This is 1952. Again, this is NPV, which is positive NPV. So we have to PVF 30%. Now again we have to create a table. First of all, write down 1 for 0 year. After that 100 by 130. 0.769 into 100 by 130. 0.591 into 100 by 130. 0.455 into 100 by 130. 0.350 into 100 by 130. This is 0.269. Again, same thing, present value at 30%. Now I have to multiply this column with column number 2. Let's do 0.6 769 into 4000 is equal to 3076. 3076. 0.591 into 4000, 2364. 0.455 into 4000, 1820. 0.35 into 4, 1400. Now 0.269 into 4000, it will be 1076. Now again we have to add 1076 plus 1400 plus 1820 plus 2364 plus 3076 is equal to 9736 minus 10,000 is equal to 264 in minus. Now problem is solved. We had two NPV. First maybe 5160 or 1952. It depends on you. But second will be 264 because we need two NPV. One should be positive, and whenever we have to take one positive NPV, it may be taken 5160 at 10%. It may be taken 1952 at 20%. But we have to taken minus 264 as second NPV. Now we have to apply the formula and solution will be here. Now because there is a limitation about the space in the board, so first of all I will rub the text and after that I will use the place again. So let's do a technique. NPV, first NPV is, I am writing here, NPV 5160 at 10%, NPV at 20%, 1952, and NPV at 30%. This is minus 264. Now let's rub the thing so that we may use the space to write down the formula of internal rate of return. Now internal rate of return, IRR, is equal to lower rate plus NPV at lower rate divided by NPV at lower rate minus NPV at higher rate into difference in rate. This is the formula. Now lower rate may be taken as 10% or 20%. If I am taking 10%, then I will use NPV 5160. If I take NPV lower at 20%, then NPV will be 1952. Now I am using NPV lower rate 20%, 20% plus. NPV at lower rate is 1952 divided by 1952 minus at higher rate is 30%. Minus plus, this is 264 into difference in rate. Because I am here taking lower rate as a 20%. So difference between lower and higher will be 10%. This is 10%. Now 20% plus 19520 divided by 1952 plus 264 equal to 2216. 20% plus 19520 divided by 2216. It is 8.8. So it will be 28.8%. This is internal rate of return. So I think it is clear to all of you. Now let's start another problem. This is the last problem and final problem. After completion of this problem, this chapter will complete, and from next lecture I will discuss another topic. So this was the problem which I solved for you in previous slide. This is next question. It is almost same, but numbers which is given to you is different. In this question it was given that a company want to purchase a machinery and it requires cash outflow of rupees 1 lakh in initial stage. Machine has life of around 5 years, and in 5 years it will generate cash flow after tax of around rupees 3 lakh. Now let's do. You have to calculate discounted payback, NPV, PI and IRR. In this question there is no need to calculate payback period. Now let's start the question. Now I will try to do it little fast. 0, 1, 2, 3, 4 and 5. Here cash flow after tax. This is 1 lakh in initial stage and it is 60,000, 60,000, 60,000, 60,000 and 60,000. Now present value factor at 10%. 1, 0.909, 0.826, 0.751, 0.683, 0.621. So first of all, simply write down the present value factor. I have write it. Now after that you have to calculate present value. So whenever you have to calculate present value, simply you have to multiply both the column. This is present value at 10%. 0.909 into 60,000, 54540, 54540. 0.826 into 60,000, 49560, 49560. 0.751 into 60,000, 45060, 45060. 0.683 into 60,000, 40980, 40980. 0.621 into 60,000, 37260, 37260. Now simply add all the things. 37260 plus 40980 plus 45060 plus 49560 plus 54540, 227400, 227400. This is the sum of present value of 227. Now first of all we had to calculate discounting payback period. So discounting payback period means you have to write down here cumulative present value. Cumulative present value. This will be 54540, 54540 plus 49560, 104100. So we are recovering 1 lakh in A number 2. So I think there is no need to fill all the column. Now let's calculate discounting payback period. For calculating discounted payback period, formula is same. 1 year plus 104 100 104 100 minus 1 lakh. Divide by 104 100 minus 54540. It will be first year plus 4100 divide by 104 100 minus 54540. This is 49560 into 1. 4100 divide by 49560, 0.08. So 1 plus 0.08. Here will be the answer. Now number 2, I had to calculate net present value. To calculate net present value, simply I have to use a formula. According to formula, first of all write down sum of present value of cash inflow minus sum of present value of cash outflow. This is 1 lakh. It will be 127,400. So NPV is 127,400 at the rate of 10%. So first of all we had to find out discounted payback period. Number 2, I had to calculate NPV and we have sold it. Now we had to calculate profitability index. As you know, the formula of profitability index is sum of present value of cash inflow divided by sum of present value of cash outflow into 100. This is 227,400 divided by 1 lakh into 100. It will be 227.40. This is the profitability index of a given machinery. So we have sold three things. Number one, discounting payback. Number two, profitability. Number two, NPV. Number three, profitability index. And number four, we had to calculate IRR. Now let's start. To find out internal rate of return, as we have discussed earlier, we need two NPV. First should be positive and second should be negative. We have calculated an NPV at the rate of 10%, and again we had to find out another NPV at different rate. So let's start. Let's try at the rate of 50%. PVF at the rate of 50%. This is one for first year. Now, simple formula. Whenever I had to calculate PVF, simple 100 by 150, it will be 0.666 into 100 by 150. It will 0.44 into 100 by 150. Into 100 by 150. 0.296 into 100 by 150. 0.197 into 100 by